Okay. So we've got 16 in there, 18. Okay. I think we've got people coming into the room now, which is great. Welcome to everyone. Thanks for joining us on the webinar this morning. Had quite a few register. I think Greg Kahn is with me. He's one of our client directors in our CFO Advisory team. Greg, we've had quite a bit of interest in this one. I think people are keen to try and get on top of overheads. It's a pretty hot topic. Just as people are joining this morning, we might just get you to drop into the chat. I'm just going to make sure everyone can participate in the chat. Everyone. If you want to just drop into your chat where you're joining us from this morning, we just want to make sure that the chat function is working. Kara's in Melbourne. G'day, Kara. Brisbane people, Southern Highlands and New South Wales. Inverell. Is it raining in Inverell? It probably is. It seems like it's raining across most of Eastern Australia at the moment and heading inland as well. I know in Brisbane at the moment, it's pretty average. Yeah, not the best. Not at the moment. Trying its best. Yes.
Melbourne and sunny. Oh my goodness.
There you go, Robert. It's going to get down to you, mate. Don't worry. It looks like everyone's going to get a touch of this one. But yeah, in southeast Queensland and up the coast, it's pretty dreary right now. Balmy Darwin. Well, good on you, Roy. It's a bloody nice time of the year to be in Darwin, I guess.
Saw Hunter Valley there as well.
Yep.
Wouldn't mind being there right now.
Yes, indeed. A semi-on, maybe, Greg, from the Hunter.
Shiraz, mate.
You go Shiraz?
Yeah.
Yeah.
I'm a Shiraz guy.
We've got, I think, quite a few in already, so we might kick off the official proceedings here. So, like I said, my name is Phil Brown. I'm COO here at Xact Accounting. And we've got Greg Kahn on the call as well, and I'll do a more formal intro to him in a sec. Our topic for today is overhead. Is it good or evil? And we'll get into it. Just a bit of housekeeping at the top. Our agenda, we're going to go over a bit of first principles. We like to do that just to set the scene and get people's head into the topic and the broader context of each subject that we look at in these webinars. So we'll do that. And then Greg's going to go through this overhead bloat calculator. So it's a tool that we've built that will really help you get some better visibility on the impact of increasing overheads as you grow. We're going to be running a couple of polls throughout just to make sure everyone's paying attention, keep you all engaged. We often get questions about, will the recordings be available? Yes, they will be. We'll be sending the recording out after the event. It'll be out either late this afternoon or tomorrow, as well as the resources that we've mentioned in the webinar as well. So, and specifically the calculator that Greg's built. So we'll be sending that out. Questions with this one today, I reckon if we can drop the questions into the chat as we go, we'll find a moment in the webinar where we can where I can jump in. So I'll ask the questions on your behalf, and just a call out to no silly questions. You know, Greg is a real expert in this space. We really don't want anyone to leave the webinar having not asked the question If you're worried about anonymity, you can send it to me directly, just the panelists. You don't have to share it in the room. But I do recommend, if you're comfortable doing so, share it with everyone so that we can sort of get a bit of a flavour of the questions that are in play. Okay, just very quickly, before I hand it over to Greg, just a quick about Xact Accounting. So we've got 3 different services. We've got a dedicated bookkeeping service, very much about system integration these days in bookkeeping, whether it's Build a Trend, Build Xact, Job Pack, whatever the flavor is in terms of your system that you're using for job management and estimating, and connecting that up to Xero, your accounting platform of choice. So that's what our bookkeeping division is expert at, and helping you with things like job costing and tracking costs in the business, not just pushing ledgers around. CFO Advisory, which is where Greg lives. This division is quite different to what most people are used to in a tax accountant. These guys are commercial accountants. They've been CFOs. They know the inside of a business, not just from a tax perspective, but how to drive better margins, profit, cost tracking, all that sort of stuff, and visibility on the road ahead, which is the big difference. And then compliance. So once Greg's done the work with you and you're turning over wonderful profits, our compliance team look after that from a tax perspective and make sure that, you know, you're not paying any more tax than you really want to. And they've got lots of interesting ways of doing that through structuring and the like. That team also looks after compliance around QBCC and home warranty, that sort of stuff in the various states. Our clients are usually scaling up. They usually come to us because they're growing or they're having trouble growing, but they want to scale up. They have a growth mindset. So I would include everyone on the call today. You have a growth mindset. If you want to learn more about this sort of stuff, that's great. And we love working with people who are open to taking on advice and new ideas about how to improve both themselves and their business. They recognise that maybe just a generalist accountant isn't the way to go. They're after someone who's a bit more specialised and knows the industry well. And they're really, it can get a bit lonely running a business, and particularly if you don't have a strong finance background. So we play this role for our clients where we run it, we're their finance running mate. We help them navigate that aspect of the business. And to point that out a little bit more, this is another little scene setter in terms of the type of content. So we do lots of different webinars. This one is more in the commercial accounting space. So I'm just going to do this little device. We've got 2 partners on the screen here at Xact Accounting, Dan, who's the head of CFO Advisory, and Josh, who is one of our client directors and partner in the tax side of the business. They're both in their mid-30s, both university qualified, of course. One is a CPA and one is a CA, and they argue about who's better all the time. They're both obviously partners in respected accounting firm. They love their numbers, eat them up morning, noon, and night. They're both obviously very good-looking roosters as well, and they have a very different purpose in terms of what they do day in, day out. So Dan and Greg as well in the CFO Advisory side, they're all about increasing profit. That is the sole, or one of the sole focus for them in the work that they do with our clients. Whereas Josh is all about helping our clients pay less tax. So a lot of people will have had a lot of experience. Everyone has to have a tax accountant, and clearly you want to have a good one who knows what they're doing. But we're all quite familiar with a tax accountant, probably less so with a commercial accountant like Greg and Dan, because they just haven't had exposure to the expertise of having a really strong financial and commercial accountant in the business. So this is the area that we're going to be focusing on today. To our presenter today, Greg. So like I said, he's one of our client directors in CFO Advisory, long background in a range of different industries, including building and construction, but a lot of experience in manufacturing as well. He's held CFO roles in a number of businesses over his career, and it's a real privilege to have him on our team at Xact. His main sort of approach, and the approach with CFO Advisory is to work our clients through these various stages. So quite often clients come to us in this survive and repair mode. So a project or projects have gone south. They've lost considerable money, or they're just not making the margins that they want, and they've had a good go at trying to work out why that's the case. Greg and the team will get involved at this point to really try and make sure that they've got the right sort of fundamentals in place to really put a better foundation in for the business from a financial perspective. Once we've done this survive and repair piece, then the team will work on stabilize and optimize. So we're out of urgency mode. We're into more of an impact mode now, and it's all about tracking margins over time and starting to really optimize things like margins and how much we really can get out of customers. Really starting to fine tune job costing, making sure that we're micro measuring everything we can, but doing that over a period of time so that you can really maximize the outcome. And then finally, full control, which is a beautiful place to be. That's where things get really interesting. It's where you can start to look at, potentially your own property developments and things like that. Some adjacent opportunities once you've got your core business really humming along. And that's where, family wealth building really comes into the picture as well. So that's what Greg does in his day in, day out. Today, we're going to be focusing on overheads, and that's where I'm going to hand it over to you, Greg, to take it from here. So I'll stop sharing and hand it over to you, mate.
All right. Let me just get this technology right, mate.
And while Greg's doing that, just a reminder, don't forget to drop your questions in as we go so that you can get your questions answered.
So just, okay, let me check this is working. Yep,
we got you.
We're good. All right. Phil, thanks for the intro, mate. I tell you what, you're really understanding what we're doing here at CFO. And if you're ever interested in a job, mate, I'm looking for someone to assist.
So I'll leave it to the experts, mate.
Yeah, that was a great introduction.
Thanks, mate.
And nice and comprehensive. So I appreciate that. Just briefly, yeah, look, for me personally, I'm a commercial accountant and with 30 years experience in the commercial environment across a whole range of sectors, building construction, retail, e-commerce, mining, ASX listed businesses, and obviously building and construction. So this is my passion. I love to talk about profit. I love to talk about optimization, systems, processes, shareholder value, overheads, budgets, cash flows, P&Ls, balance sheets, and really driving shareholder value, which is you, and what's going into your pockets. We're here to achieve your goals, and we're able to do that effectively. And sometimes, we do have a lot of people that come to us that are in a world of hurt. And it's our job, as Phil outlined there, is to get through that survival phase initially. And once we can get out of that, we can start to put systems and processes and have really good financial clarity around what we're doing to make better informed decisions, which then lead to obviously that full control piece. So welcome everyone. We've got a little bit to get through today, and there is a fair bit of detail. Even though some of these slides look quite simple, I am going to talk through those in detail. So let me just lens a little bit here as to what we're going to cover off in the next couple of slides. Firstly, I'll talk to you about what a good business looks like in the building and construction industry and the importance of COGS. Now, COGS is cost of goods sold. So some people call it COGS, some people use the full name, but it is the direct costs that are related to earning $1 worth of revenue. So we're going to walk through this slide and show you, what a gross revenue business that's turning over $1 million should look like in this industry. We'll then move into what pain looks like for businesses, and and for those that don't control their costs, both directly and indirectly into overheads. You know, we don't want to be in a painful working environment. However, it is not uncommon for us to work with clients that are in a world of cash flow hurt and a world of net profit hurt. Thirdly, we're going to show you what a great business looks like, and we're going to talk through how you can get into that phase and what that means for you and your business. So we're going to place a lot of focus on COGS at this point, your gross profit and your net profit, but you do need to keep an eye on your overheads. And what we usually see is that businesses that are taking off with lots of top line growth and owners getting busier and busier, that they start to pile on those overheads. So without a good plan and for how this will impact profit, just remember that each one of these overheads is coming straight out of your net profit. So we'll talk through that. We're not saying that overheads are bad. Actually, you can't grow without them. But we need to have visibility on the impact of these overheads. So you need to get your timing right. And most importantly, if you're going to bring on more overhead, how much revenue do you need to make sure that your margins don't suffer? Okay, so let's get into this first slide here. I have another screen, so I'm just going to move my little arrow around and talk to this particular table. So what we've got on the left-hand side here is the gross revenue of a business turning over $1 million. Now, the major component of this particular business is its cost of goods sold. 80% of its effort goes into earning that revenue. So it is a significant area of concern. It is an area that we should be spending 80% of our time on. And what you want to do inside this particular area is that you should be measuring line by line. You should be understanding what makes up your cost of goods sold. Who are the trades that are in there? What is that amount that's in your estimate? What is that amount versus the supplier invoice coming in? So 80% of your effort goes into cost of goods sold. So you've got income up the top. You take your cost of goods sold away and you end up with a gross profit. Now, the gross profit or gross margin, it's one and the same, is going to be 20%. So $200,000 from your gross margin or gross profit is taking your overheads. So $100,000 worth of those overheads is going to come out of this example. That leaves you with a net profit of $100,000. So 200 minus 100 equals 100 net. Now, what we like to see in building and construction businesses is this scenario, which is 20% gross profit, 10% overhead, 10% net profit. That's the benchmark that we're looking for. Now, it will differ whether you're doing commercial, whether you're doing maintenance, whether you're doing resi, whether you're doing any other type of work there. But in general, that's what we like to see running through these businesses. Now, as you can see here, this is a statement that says, you know, this is almost irrelevant. So if you're thinking about where you should be focused in your business, overhead is important. And we're going that is the theme of the presentation. And there are ways to make sure that you can cover off overhead without losing net profit. But it is 10% of your business. So if you look at it as a whole, your real focus is up here in this cost of goods sold. So cost of goods sold will make or break you. If we increase telephone expenses down here, or we get a little bit of a rent increase, or we spend more on our staff amenities, as a whole, it's not a big ticket changer. It's this particular area up here. So the battle is won or lost in cost of goods sold. If there are overruns that are coming through from your estimate to your actuals, we need to know about that. All of these expenses that are going into your cost of goods sold, they're an enabler of profit. Because remember, what comes out is revenue minus COGS gives you gross profit. So these items enable profit. These items here start to erode that profit. So that's just an important point to make. So inside here, what would we see normally? We would see plastering. concreting, fencing, painting, plumbing, joinery, all of those trades and all of the direct expenses that relate to earning that particular $1 in revenue. Now, this number down here, this is your net profit. This is the prize. This is what we call our shareholder value. If I refer to that today, what I'm referring to is this bottom line, this net profit. Now, this is after your wage. Your wage is either going to come in here in overhead or it's going to be split between overhead and COGS. It depends whether you're on the tools and you're earning that $1 revenue directly, or your overheads, or you're sitting in here. Now, you don't have to be in one or the other. You can be in both. It's not a problem. It's just a journal. At the end of the day, you look at the wage, you do a journal, you say, I'm doing 70% on the tools this month, you shift it over here into COGS, brings your margin down, and your overhead comes down by that amount as well. Net profit remains the same, but you've got to split right. And why do we want the split right? Job by job profitability. So we want to understand our job by job profitability and those direct costs that are relating to that. So 20-10-10, this is what we're looking for in this particular slide. So let's move over to the next one. What does pain look like? Now, none of us want to be in this situation. Pain in this example is when your COGS moves. So it's gone from 80% to 90%. So now 90% of your effort is required to earn $1, where before it was only 80% of your effort. So if your COGS has increased, your margin's going to come down. Your gross margin, you're only going to be left with $100,000 in gross margin. Now, a double whammy is that if your overheads go up by $50,000 over and above the previous example, you're now running at 15%. And the difference between 100 and 150 is a $50,000 net loss. So we don't want to see these sorts of things happening. But unfortunately, it happens all the time. And this puts you in a world of hurt. And not only from a net profit perspective, this is what a P&L looks like, but what's the cash impact of that? That's going to be significant as well. So, you know, what are items that are sitting in here? Again, we're talking about tiling, roofing, earthworks, they're all going into here. But why has it gone from 80 to 90? You've most likely had some blowouts in some of these expenses, some overruns in some of these expenses. There might be poor micromanagement of line by line, checking between your estimate and the invoice that comes in. And it could be simply someone increasing their rates to you without informing you. And look, that's a real scenario. I've seen it before where, you know, a painter comes along in February and tells the foreman on site that he's going to increase his hourly rate by $15 an hour. And 6 months later, you know, let's not say 6 months, we implement a purchase order system for this particular client. They start raising a purchase order of, say, $10,000 for the painting, and in comes the bill for $12,000. So the first question there is, why is it $2,000 more than what it should be, and $2,000 more than what I've estimated and quoted to the client? And the story goes along the line that the client tells the foreman that I'm increasing my rates, but what is that? Where is the approval for that? You know, the guys on site don't have approval to change the rate. That should be coming back through directors. So, and that should be coming back through an approval process where you do formally agree those things. Now, these things happen all the time. That's going to raise your cost of goods sold. But how do you defend against that? You need to defend against that by having a purchase order system in place, so that when you send your purchase order to the client or to the contractor, they understand that, you know, we have agreed that this is an $8,000 job or a $10,000 job. And if there's any variation to that, well, then that's a discussion. It's not a pre-agreement that it's all okay. It's a discussion. And then if there is a change to that environment for whatever reason, you should be looking at a variation back onto the client. So you don't need to be wearing these expenses, and you need to have the confidence and the ability to debate these sorts of things in your business. And if you don't, well, then you bring in a CFO like me, and then we have those discussions and we sort these things out for you as well. So, you know, this is pain. This is 90%. We wanted at 80, sorry. And we're starting now to kick up a loss. What I talk to clients about all the time is defending and protecting your margin. It's your gross margin that pays your bills. And you can see that it sits above this line here. Gross margin sits in here. That's what pays your overheads. If you don't have enough of it, you're going to go backwards very, very quickly. So the other part that I want to talk to here is, there's two really important things. In order to defend this, you need to have a control mechanism. And what is that? It's a purchase order system. I see so many companies that just don't have a purchase order control system in place. You're giving that to someone. It's $5,000 to do this job. Send me an invoice for $5,000 when you finish. If there's any variation, talk to me about it. I'll agree or disagree to pay you that amount. So if you keep absorbing overruns and you do nothing about it, two things will happen. One is you'll lose money, and the second is it will compound, and it'll compound across the number of jobs that you have on the go. Now, you might have only 4 or 5 and not think that's too much of an issue, but the building and construction industry, you know, you don't have enough margin to be giving it away. You don't have enough margin to be able to, you know, absorb overruns or absorb things that other people do wrong. You need to be able to defend that and protect it constantly, and you need the confidence to be able to do that. So that's one really important issue that I want to put on the table there. Second is the estimating process. You know, for me, the builder in all of the industry clients that I work with is the best estimator. It is your skill set. You're great. You know what you're doing. But as your business grows and scales, you end up doing that estimating on hour 71 in the week. You know, you're managing jobs, you're running projects, you're you know, you're looking at your staff, you're potentially advertising or doing something on LinkedIn or Instagram, or, you know, you're trying to grow your business. And then you've done 60, 65 hours in the week. And then you've got to go and start working on estimating and building and doing all these things. At what point do you consider that maybe somebody else should be doing that? And what can happen if you don't, when you're at that sort of level and you're working those sorts of hours, you will make mistakes. And those mistakes can be compounded very, very quickly. If you don't have a purchase order system in place, your compounded error is only going to be picked up sometime later on for, you know, however you go about identifying that there was an issue. Otherwise, it'll go unchecked. And I've seen many times that these errors can last for 6 months. And these errors can be as simple as your spreadsheet that you use. If you're not using Build Xact or Build a Trend, you're using Excel, which a lot of people do. If you have an error there, how many times is that going to be compounded into the next number of jobs that you've got? And what if you're not bringing totals across? You might think you are, and you might think it's all, but it's really surprising how many times some of the first things I do is go and add stuff up. And I make sure totals equal totals and lines equal lines. And it's such a basic functionality, but I've seen so many times errors that occur. Now, if your build cost was $430 and you forgot to extend across an additional $10,000 for whatever reason, then you're $10,000 out of pocket. You're going to wear it. And you might have to wear it 5, 6 times, or if you're a large builder, you might have to wear it 30, 40, 50 times until you pick up that variance. So this is how COGS can start to blow out. So defend and protect and don't absorb. That's my recommendation there. Now, overhead's increasing. So this can happen. And that could be that you've increased some wages, 3 or 5% to some admin staff. Your maintenance costs have increased. You're spending a little bit more on entertainment because you're trying to secure new people. You might have some training requirements there. Your jobs may take you in a, geographically a little more diverse. So you might be running from the north side to the south side. You might be running over a bridge, under a bridge, wherever it is. And you might be doing more Ks, and there may be more travel, and you might have to do some accommodation, or you might be sending your crew off and you have to start accommodating. These are all parts of how overheads can increase. Software, well, they're never going to miss you. Recruitment, you might put someone on and pay a recruiter some money. Accounting costs, dealing with the right people. You've got compliance requirements. You've got to do tax returns in Queensland. You've got the QBCC, the MFR, the NTAs, all of your compliance requirements. And you might decide to spend some more money on advertising and marketing, which means that overheads, they're going to grow. And naturally, they'll grow when you scale your business. So this is our overhead bloat piece. How are we going to maintain that? How are we going to keep that in control so we don't get into a situation where we're actually spending more on overheads, being less vigilant in our management of our jobs, and throwing money out the back door? So we'll get to that when we get to our overhead bloat calculator. I'm going to talk through that and what that means and how you can stop those sorts of things happening. So the other instance in and around, no, actually, I'll bring that up on the next slide. So let's go to that next slide. I think I've covered off enough there to talk through what pain looks like, and none of us want to be in this particular situation. If you're in pain, give us a ring, talk to us. It's our job. We will get you out of, well, we will attempt to get you out of pain, but there can be multiple avenues of pain. One can be net profit. One can be cash flow hurt. One could be your structure. It could be that you don't have enough goals. Don't have a budget. You don't know where you're going. Should you stay at a certain level? Should you scale? Should you reduce? What are your hourly situations like? What is your mental capacity right now? And how can we help you with that? What clarity do you have around your numbers? How can you make better informed decisions so you don't have pain? We help with all of that. Next slide. What does great look like? Okay. Great for us is getting 25% margin. So COGS is at 75, meaning that you're at 25% gross margin. So before we talked about 20, that's a pretty much an industry sort of standard there around building and construction. But if you're talking other businesses, they will get more than that. Your mix will get you more than that. Depending on whether you're in manufacturing or you're in other types of environments, 25 may not be what is the normal. But in this particular industry, if we were to get to here, which is possible, what size are our jobs? Where are we doing these particular jobs? Are we utilizing the ideal client? Are we going with cost plus? Are we doing with it on a fixed price contract? Then we look at whether you're doing maintenance type roles and what the value of those are and how that can impact and what sort of margin you should get on that. And as we would know, if we're doing a residential build versus a commercial build, there's different margins there. So we need to weigh all that up. But what great looks like to us is someone that is able to get 25% gross margin. Overheads come down. We target single digit overheads. That's our focus. We want to see single digit overheads. If you're above single digit overheads, it is quite possible that you're too heavy. But the other thing is that 8% is a relationship to sales. So there's a balancing act between if you're turning over $1 million or $1.8 million or $5-10 million. that value of overheads and that ratio to overheads is quite important, because 8%, whilst here it looks great, it could be too low for your business. We could see, we could see that perhaps you need to add overheads to your business. I mean, I see these single digit ones come through, and the majority of the time they are too skinny. They don't have the sales, admin, support staff. Everyone's working absurd hours. Everyone's committed. They got high values. They love the boss and the owners and the directors. Everyone's got the passion there, but guess what? They're all working far too hard, and they need to work smarter. And that may be as simple as putting on an estimator to free up time to work on the business, putting on sales admin staff, putting on another foreman or a project manager. But when you do that, today when we talk about the bloat calculator, we'll tell you how you need to do that. So single digits is where we need to be, but we also need to measure that against what activity is happening in the business. So in this example, we have 25% gross profit. We're taking out 8% in our overheads, and we've landed at 17% net profit. This is fantastic. If anyone's sitting in around that mark, well, then that's just awesome. Anything above 10 is very good. So this is the size of the prize. This is your net profit. This is shareholder value. This is what drives back to you at the end of the day. But this is after you pay yourself as well. So you're paying yourself up here in COGS, you're paying yourself in overheads. If that's the case, you're splitting between the two. What falls out the bottom is what you're entitled to. And again, what happens here, and this is different, my job is to generate and ensure that you are micro measuring line by line, accuracy, detail, defending, protecting your gross margin. Your gross margin pays your overheads. Okay, what are overheads delivering to the business? What do we need? What do we don't need? Tax guys, guess what? We made a huge profit. Now let's go and save the client some money. Let's have a look at what we need to do in order to improve, to keep to a minimal the amount of tax that we're paying. My job's to get that as high as possible. Tax guys is to bring that down. And this is where tax planning comes into it. And this is what's great at Xact. We've got the three divisions. We've got the CFO guys, we've got the tax guys, and the bookkeepers. So those three pieces of functionality, they form the whole of the service into this industry. And I work alongside our tax guys when it comes to this point to making sure that the directors, owners, shareholders understand what we're talking about when we're talking about asset protection, setting up a new business, setting up a trust if that was the way that it was going, Div 7A loans, franked dividends, all these things, terminologies you may not quite understand. We help you understand those because we want to make this as tax effective for you as possible once we've finished the process of making you as optimal as possible. All right, so I'm going to move on to the next slide. Now, this is earners versus burners. Know the difference. So I'm just going to click through these because I like to have them all on the screen rather than just coming through every now and then. It's important to separate earners versus burners. Now, burners, to me, it's a little bit harsh because it's just a terminology, but it is when you're sitting in the overhead category, and we'll talk to that. But earners would be, one group that live above the gross margin line and is a product of making you money is an earner. So they're earning you money. What would that be? Bricklayers, joinery, demolition, carpenters, all the trades that go into building the building that you get paid for. So when you're thinking about what is an earner, these are the costs that directly generate revenue. They are a product of making you money. Earners live above the gross margin line, and we'll show you that in the next slide. I'll show you a P&L and what it looks like. A burner, they live below the gross margin line. It's a harsh name, but it's an expense that supports you making money. So what would that be? What would an expense for a burner be? Well, your accounting is a burner. Even though we as CFOs add lots of value to the whole process, the accounting function as such, tax, compliance, but that's an expense, lives below the line. Advertising, marketing, bank fees, entertainment expenses, motor vehicle expenses relating to the admin staff that may have a vehicle, rent, electricity, telephone, uniforms. So these are things that are below the gross margin line, and they're an overhead, and they help you run your business. So one of these helps generate profit, and one of these consumes your profit. So even though you're consuming because it's your cost of goods sold, is directly related to getting paid for that building. Both of these impact you on the bottom line. Very important. So what I want to get into now, and this is awesome, a profit and loss refresher. So let's have a look at what a profit and loss should look like in your business. I see so many of these and they don't look like this at all. They look like a standard zero setup file, straight out of the box chart of accounts, which leads to, at the end of the day, a complete lack of financial visibility and clarity. So what we want to see is some very simple fundamentals here. Trading income, cost of sales, operating expenses, net profit. That's what it should look like in every particular one. Now, when we talk about other industries and other businesses, there are different costs of goods sold, there are different expenses, and there may be some divisional structures that get included. There may be departmental structures. There may be, an extrapolation of the chart of accounts across, Australia-wide by industry, by cost center. So this is in its most simplistic form what a building and construction business can look like, because it's not one of all of those others. We're not talking multiple sales of multiple products and e-commerce and cost centers and making products from scratch and everything else that goes into all of those other industries. So here, trading income, we put it at the top, of course. In this particular example, we've got income. We've also got work in progress. So this is positive WIP in this example. Now, I can't spend enough time going through work in progress. We've got webinars on that and we've got what it means. But in this example, this is positive WIP of 174. It brings the trading income up. Now, why does it? Because you have worn the expense in this business and you have not claimed yet the revenue you're entitled to. So as accountants, we do this every single month. We have so many that come across the line that don't do WIP, and this is critical. WIP is critical. Now, what this may tell me is that you're wearing, if this is positive WIP, you're wearing 174, well, this less the margin, $150,000 worth of cost in your business that you've not yet charged to your client. So what happens with cash flow? Goes down. Now, if you're scaling your business and you're doing multiple projects and you have 3 times this amount of money as positive WIP, I'll tell you, you're going to be in a cash flow pain. So it's important to consider positive WIP and or negative WIP, whether you're using client money, whether you're using your own money, and what the impact on your revenue is. So look, we've got the tools there, the webinars are there. Dan's done those on our site. Download them, read them, watch them. They're all great. They will give you an understanding of what WIP means. So we've got our income 333, we've got our cost of sales. So in here, brick supply, consultants, earthworks, electrical, painting, tiling, all the trades. And they make up the cost in that month that earned that revenue. Down here, we have a gross profit number. Call it gross margin, gross profit. Either, it's both the same. The dollar value is 76. Gross profit percentage is 23%. Very simple calculation. that number divided by that number. That is your gross profit number. If your accounts don't show that in Xero, MyAlba, or QuickBooks, you need to get that in there. This is an important number to know. You know, I like to talk to my clients and ask them 4 things. What's your revenue? What's your gross profit? What's your overhead percentage? What's your net? You need to know those numbers in your business. And we just find that these are numbers that when we start asking questions, lots of potential clients don't understand that. So we come down, we've got our gross profit number. Then here's our operating expenses: accounting, advertising. Annual leave needs to go through. You have to accrue for your employees, any bank fees, entertainment, insurance going through your business that's related to an overhead, motor vehicle expenses for staff that have got rent, electricity, uniforms, and wages, admin staff. Again, total operating expenses 43. Divide that into your total trading income. Overhead is 13%. Key number to understand. Net profit, difference between this and this. Gross profit minus your overheads, 32,000. This example, net profit percentage. Need to know these numbers. Whoops, accidentally clicked. So this is what a profit and loss looks like. Know this, know where we're going. Now, if you've got cost of goods sold into some of these areas, you're picking up your trades in operating, you're picking up this or that or whatever, it's very easy to recategorize those things. And that's where you're improving your financial clarity. If you're looking at these numbers and you're understanding that perhaps this should not be in here, it should be over here, perhaps what's in here should be back over here, that's excellent. That's what we want to talk about. We want to get that right, because what we want to get right is, what does this gross profit number look like here? What are you estimating at? If you're estimating at 23, we should be getting 23. If you're estimating at 23 and you're getting 15, we need to dive into that. That's our line by line measurement. Why is that happening? Why are we not getting what we expect to get out of our gross profit? Overruns, this guy's done that, site delays, earthworks, hit rocks, didn't quote the customer, wearing a not charging variations, haven't been able to do it, wasn't in contract. That's going to drive down that gross profit. We want to check that monthly, line by line, by job. And that's how we find improvements. So that's enough around about the profit and loss refresher. Just quickly, as an added bonus, I just want to briefly mention the balance sheet. And the reason I want to mention that is that the balance sheet and the profit and loss tell 2 different stories. But lots of people get intimidated by a balance sheet and they say, I don't get it. I don't understand a balance sheet. What does it mean? Just remember this as a 101 on balance sheet. It is what you own versus what you owe. Assets minus liabilities. The difference is your equity that belongs to you. It's no more complicated than that. Now, we get in and verify balances and move things between current and non-current, and it's all for NTA purposes or MFR purposes, or strengthening a balance sheet, moving assets. But at the end of the day, quite simply, it's what you own versus what you owe. So that's just a little 101 around about the balance sheet there. So Phil, I think that leads over to you now.
That was great. Thanks for the intro bit there, Greg. A lot of really good, solid detail there. You've covered off, just sort of setting the scene for this calculator you're going to go through. I'm just going to launch now, though, this quick little quiz just to make sure everyone's been paying attention. I'm sure a lot of you know this already, but I'm just going to launch this one. I just wouldn't mind if you can tell us which of these, and you can choose more than one, overhead costs. So which of these are considered overhead costs? just jump on and let us know which ones you think they are. And I've got quite a few coming through, Grego. I think everyone, sorry for you, mate, but everyone knows that accounting fee is an overhead. So we've got 100% strike rate on that. Estimator wages, we're a bit unsure. We're sitting at 70% of people reckon that estimator wages are going to be an overhead. Site manager wages, we're sitting at 33%. So the majority don't think that's an overhead. A few people think that kitchen and concrete are overhead. So let's just, I think that's pretty good. Everyone's just about everyone in now. So I'll just close that one out and we'll share those results. Greg, accounting fees, overhead or COG?
Overhead.
Can you recover them in any way? Is there any way you can?
Well, there are ways to. It depends on the your setup of your estimate. But look, there's abilities to recover overhead costs inside your estimate and what you're doing in that space. So multiple ways to do that. So yes.
Same, I guess, with estimator. I mean, traditionally, we would see the estimator as being an overhead expense. But there are, and someone's, we've had a comment in the background saying, you can charge the estimator on as part of the job.
Yeah.
We do see that from time to time.
So it is subjective too, Phil. Like it depends what you're doing and how you're doing. There are some people out there that are very good at recovering every single little piece of what's going into that particular job, and they are very successful. And then there are others that don't do it as well. But yeah.
I think we do see people try and get a bit tricky with recovering a lot of what would traditionally be overhead costs in COGS and on charging and that sort of stuff. And look, if you can do it, great. But what I guess the discipline we're looking for is really properly measuring what are your actual COGS that are related to that specific job, so that job by job you can see what your gross margin's looking like. And so all well and good if you can, on a quote or an estimate, you can, build these other aspects in. But when you're looking at your scorecard for your performance, try not to dilute it by having things that aren't related to that specific job included in your measurement. All right, we're going to keep moving because I really want to get into your calculator, mate.
Yeah.
So I'm going to stop sharing that. And we'll hand it back over to you. There was a question in the background there as well around, or a suggestion about having an estimator as early as you can, or like rather than doing estimating yourself. I think you gave that as an example, Greg, that, really having someone, just because you can estimate doesn't mean that you should necessarily, particularly as you're growing. But you can argue the other side of that too. It's such a critical piece. So if you're really good at it, you enjoy it, and you've got the time for it, then it's an important thing to be all over. Just be very clear on why you're making that decision, and be careful.
Time, Phil.
Yep. Exactly.
That's the critical piece.
Yep.
At some stage we look as owners, we're going from running a couple of jobs to running a business. There's more governance around that. There's more quality, health, safety. There's compliance. There's all of these things, and you end up absorbing all of that, and you're still quoting. You're still estimating.
Yep.
We look at the tasks that somebody undertakes who's in that position, and we say, it's not a low-level task. It's very, very important, but it's consuming 30% of your time, 40% of your time. Do we bring someone in to do that? Do we outsource it? That's a possibility. Or do we drop some other tasks that you're doing and put that onto someone else who's, perhaps project managing, and you focus more on that estimating? And sometimes we do that because we find that we can make a lot of money when we get our estimating right. And if the owner is the one that's out there doing it and he's converting and he knows all about it and he gets that sale across the line, that's ideal. Everyone's
Righto.
different. Yeah.
We might move on, Grego. Let's get onto your calculator, mate.
So,
I'll let you share that now.
right. So I just got to remember where I was, Bill, to share. Hold on. Oh, it's up here. So new share.
And we're going to do the express version of this one, Grego.
Okay. Awesome. Can
A
you see that,
reminder,
Bill?
yeah, I can see that. And a reminder that if anyone does need to drop off for other commitments, we will be sharing this video afterwards. So, but hang on, because it'd be good to get your questions answered as well as we go. So go for it, Grego.
All right. So let's do the express version. What we're looking at here is the overhead bloat calculator. The top section here is the default one that is available on the website that you can download. What I've done is I've just extrapolated out a few numbers. I want to talk to you about what that means and the impact. Now we're bringing up estimator a little bit, but it can be sales, an administrator, or it could be advertising and promotion spend. So what we're looking at here is a break-even calculator. If an employee costs you $120,000, then we're going to enter it into this cell. We are then going to take and look at the builder's gross margin. We're going to divide this into the margin. What that does is deliver you what that revenue number is that you need to achieve to pay for this $120,000. So just remember you're looking at the total economic cost of this particular employee, and that means wages plus super plus car plus allowances, not just their wage. But in this example, if we put on an additional person into the business at 120 and our margin's 20, we need to find 600,000 in more revenue to come into that business. Now, I'll talk to that impact in a second, but I'll just show you, if your margin's at 15%, you actually need to find $800,000 in revenue. Now, if we go back and say you're at 20 and this person's going to cost you 80, well, not 800, my Lord, wouldn't that be nice? 80,000, it's only going to cost you 400. But if your margin's at 12, you're going to need 666. So this is how this calculator works. Put in your margin and put in your cost. Now, it doesn't have to be a person. It can just be $25,000 worth of something. It could be an additional vehicle. So what we're looking at here is that there is your overhead costs that you want to add to the business. This is the revenue you want to add. Now, what I want to show down here is just this example. This is a $500,000 business. Sorry, a $5 million business. It earns 20% gross margin, 500 in overheads, 10% falls out the bottom line. Your net profit is 500,000. Now, after you add that overhead, which comes in here, these new overheads, if you don't do anything with your revenue, obviously adding 120,000 is going to increase your overheads to 620, takes your percentage up and drops your net profit. So your net profit comes down from 500 to 380, and your quality of earnings is down at 7.6 now. So you just absorb that person and do nothing with revenue. That's not recommended. If you then take your break-even number, you use the calculator and it says you need to go and find $600,000 additional revenue. So look, we've added 600,000. We're still doing 20% profit. We've incorporated our new overhead of 620. We're actually back to where we were from a dollar perspective. That's important. We add 6, but we're now back to our 500,000. But look at our quality of earnings. The quality of earnings by increasing revenue and adding overheads has decreased. Now, if you're an investor and you're looking at businesses, you're looking at this particular number. What is that percentage? What is the quality of this business? What is it doing for me? The reason this is dropped is because we didn't add any margin to the break even. So what I like to do is I like to extend out over here and say, well, we need 600,000 in additional revenue. but my business operates at a 20% margin. So what's the markup I need to develop, to allow me to take 20% margin? So the markup's 25 means I need to find a contract worth 750, not 600, because that's going to have my margin in it of 150. Now, when I include the margin, you can see the difference here is the inclusion of this margin. Our gross profit goes up. We've incorporated the 120. Look at the net profit. Goes up to 650, and our quality of earnings has gone up. So the simple decision that we made, I want to put on an estimator. I don't want to break even by putting them on. Why would I? I actually want to earn some money out of this person. What do I need to do in order to do that? I need to go and find a contract worth 750. Now that may be 2, 3 contracts, depend on what you're doing, but guess what? You need to find $750,000 project, sign it off, and that'll put you in this situation. So this is where overhead bloat calculator becomes important. If you do nothing, you can see that your quality of earnings is just going to drop. Simple mathematics. You need to start thinking about my break-even point and the margin that I want to obtain. So the summary points down here, and I am moving a little bit quickly because we've been on the call now for a little bit. 1 extra build for a new person. Same dollar is maintained, but your quality of earnings diminishes if you just use the break-even number. And break-even's not a gold star. You know, we don't want to be in that situation. We need to be thinking, let's add some margin, let's deliver some profit, let's increase shareholder value. Margin is critical. Quality of your net dollar earned is important. It's now 11.3. Now, budgeting is critical in this particular instance. Additional crew, equipment, vehicles, project manager. So when we're thinking about whether we're adding this person on, we're adding extra expenditure, we're going into advertising, we're going to go and do this, that, whatever, they're going to add overheads into this section here. We want to determine how much extra revenue we need. And to do that effectively, you must have a budget. And out of the bottom of the budget falls a cash flow. It's absolutely one thing that we do with every single client is put one of those in because we need to measure. So I'll talk to that a little bit more. But Bill, I think that that's my version of that overhead bloat.
Which is great. So we can really just see the impact there that you've got to have on top line once you add your overhead expenses. And like Greg said, you know, we use the example of an estimator there, but that could be, you know, 25 grand in marketing, for example. You know, so if I spend another 50 on marketing, what does that mean in terms of top line that I've got to generate? We like the estimator as an example here because it also shows, okay, well, I'm going to have an estimator in play. I need to go and get another 750 of revenue was the example Greg gave. Well, that's okay then, because now I'm not spending all that time estimating the job. I can go and win the jobs and improve the quality of the jobs that I'm winning as well, the type of clients that I'm working with. And in terms of the best leverage for your time as an owner, that might be a better solution for you. Greg, I think if you can, it would be good just to, so this Bloat Calculator, we love the name Bloat Calculator, but this is a good handy little reference. But if you've got that budget tool there, it would be good just to quickly show that. This is sort of, whilst it's a good reckoner for overhead Bloat Calculator, it's a bit back of the beer coaster, and it shows you just one spend in one dimension. One of the things that Greg and his team work with our clients on is building up a budget like this. You know, we don't have time to go through the detail on this, and we've got another webinar. You can look on our webpage. We'll send a link out to it that shows you how this budget is built up. But really, you know, a budget is a tool that we use to plug in all of the known knowns. So all of the claims that we know are coming through, all the costs per project that are going to come through. when they're going to hit, so which month they're going to be hitting, both from an income and a cost perspective, so that you can get a lot of clarity around what's happening over the next 12 months. Obviously, the next 6 months you'll see with a fair degree of certainty, because you will have signed projects and they're going to be working their way through. It'll then allow you to see where you're going to have cash flow holes. So you might see that you've got a lot of projects where you're wearing a number of costs in a particular month. You might not have projects up to a point where you can be making claims for them, and so you're going to run into some cash flow issues. If you can see that in advance, so you can predict where those holes are going to be, then you can work to rearrange payment schedules. You can work to rearrange accounts payable. You can go and try and land some small jobs potentially. You can front load a contract that you were even more than you had planned on doing so, just to make sure that you cover that hole. Or, it might be that you need a credit facility to do so. It's better to be negotiating something like credit, well in advance than on the spot when you need it. So the budget is the tool that we use, and Greg, this is one of the core pillars of the service that he gets involved with our clients, to really help improve the visibility, not of what's happened before, although we do bring in that actual performance each month. So once you roll over a new month, we'll bring in that actual number and compare it to what our budget number was, so we can drill down and find out where we've gone off track. So yes, it's important to have that ongoing performance piece in it, but really a lot of the value with this comes from predicting what's going to happen into the future with a pretty high degree of certainty. I mean, this stuff we shouldn't be guessing about this stuff. We've got contracts in play. We should know when things are landing. Yes, things will change, but then we just update the budget when we know that something has changed. So that's just a brief overview. Greg, you want to add anything to that? I hope I've covered it well enough for you, mate.
No, mate, look, you covered it really well. I'll just spend a minute on it here. This is where our templates start. You need to adapt this template to your organization. I always start out to the right. Who are the people? What do they do? Where are we allocating them? How much do they get paid? When do they get paid? And then what the impact of that is over a year. We start at salaries. We then start looking at our admin expenses. And over here, we put in actuals and we forecast out. So we do look at what averages are, and then we look at reality, because these things change. And then we incorporate percentage changes. So things like fuel, I'm adding, 10 and 15% costs to that for this financial year, where I might only add 3% to software. The admin expenses is then summarized up. You got a cost profile, which is reflective of the margin that comes from the revenue. So we go into revenue and we go, right, what are your jobs? When are you going to do them? Now, project 3 and 4 in this example are blue sky. So we want to start something in September. We want to start something in another month. If we don't have them as contracts, we need to find them. And this is where we start. And we would have done that by looking at this cash flow and saying, well, this is the money and when you're going to get it based on your payment terms. You've got a hole in your business. You got a hole coming that's going to really hurt you, down here. We need to start to bring in some more revenue. So we've done that. And we'll set the target. You've got to go and find a job to start off in May. We'll start off in October. So, this is where we split all these sorts of things out. The margin takes care of itself. We just need to know what that is. It drives the cost profile. And at the end of the day, we've got a working budget. Down here, this business is turning over 3 mil, making 23%. All the expenses come through, whether they've been scaled to seasonality and so forth. Down the bottom line, we're going to say, well, look, we're aiming for 13% net profit. We'll then take that, put it in a management reporting pack, and we're going to check that line by line, month by month. We're going to check it to the previous month. We're going to check it to the same month last year, and we're going to talk to the variances, and we're going to understand why. Now, it's okay if we make mistakes and we don't do things and we don't follow a certain pathway, but we need to understand why. Why aren't we doing that? We might take a slight turn. in our strategy. We may lose a key person within the business, and that may change what the destiny looks like. But budgets provide goals, and we need to micromanage and measure these particular goals, because it's all about delivering this value to you at the end of the day. Super critical piece of information. Love working in this space. It is so good to be able to talk strategy with clients and understand how we're going to increase, how we're going to scale, whether we want to maintain. What is that number down the bottom? Do you want 1 million? Do you want 200? What are you comfortable with? What's it look like? Work out all of those things. And with a plan, we know where we're going. And with a plan, we can measure.
And I think the other key thing, that's the financial dimension, but there's a sort of a mental dimension to this too, Greg, I gather. Once you have this kind of clarity, you talk about a blue sky project there. If that wasn't in there, you can really see what the impact to the budget is going to be if you haven't landed these additional projects. But, just having the clarity that that you've got to have, projects starting to land at certain points throughout the year means that you're not sort of really stressing unduly about what's happening in the future. And that's just sort of one example there. So we might, so if anyone's interested, we'll send out a link for a webinar that we did on budgeting so that people can watch that through. We've got this template that Greg's showing as well that people can download. But we highly recommend you have a look at and have a go at it. Greg, we might just move back if you want to. I'll just share now these final slides. So the topic today, overhead. Yes, businesses grow. We see it all the time, and they get successful. They get a lot of revenue coming through, but it can breed an awful lot of overhead success. But that is okay. Overhead is okay. We're not accountants who are going to come in and just start slashing overhead. It just needs to be managed properly, and you need to have good visibility around it and when the overhead is going to land. So that you're not eroding your profit, your net profit at the end of the day. Just quickly, we've got a bunch of events coming up. A lot of them, we're involved with master builders. We've got a couple that are happening for those people who are in Queensland. We call them the accountant in the house session. You can get some one-on-one time. We set up down the Gold Coast and in Brisbane office for the day, and you can book a one-on-one session with our team at the Master Builders office face-to-face. So that's really good. We've got our Spring Golf Day coming up with Master Builders as well. So that's September. Grego's a real good hand on the golf course. He'll be there playing, so it'd be good to see people. That's a bit more of a social event, that one, but there's lots of events coming up. We also, our next webinar we'll be running next month is on property development for builders. So we'll be looking at trying to optimize the financial and tax outcomes from property development. We often see builders get involved and tradies in their own developments. Once they enjoy a bit of success, they start to look at doing their own developments. There's a whole lot to consider in that space from a tax perspective, in particular, to make sure you get it right and get the best financial outcome. So we'll invite you along to that one. Keep your eye out for the invite on that. So I did want to, just at the end here, we've got Greg is happy to do, and his team are more than happy to do some free consultations. So that we can, I guess, offer that to the right people. I thought we would just do a quick little poll on that. So that if you are interested in booking a free session with Greg or one of his team members, one of the other CFOs, please reach out. You can do that by just clicking the button now. and we'll get back in touch with you guys to set up a time. It's really just anything you want to ask. If you're interested in how our service works, obviously you can ask that as well. But if you're interested in how to navigate the budget, how to set it up, how to calculate WIP, any of those sorts of kind of commercial accounting topics, we're more than happy to spend some time with you and help you understand how that works. I mean, obviously we do this commercially, we do it as a business, but we're also pretty involved at an industry level as well. We know that the building and construction industry doesn't always get the best rap in terms of businesses going broke and all that sort of stuff. So anything we can do to, I guess, help builders and others in the industry improve their financial literacy, we're really happy to get involved in that space. So please reach out. We'd be happy to help you out. Okay, I think that's it, Grego.
Yep.
Well done. Thanks for that session. I'm happy if people do want to ask some questions. We're happy to take a few more now. Not too many on this one. That's fine. Sometimes we don't get a lot of questions. Sometimes we do. It's a fair bit that people have had to process there. So that's fine. And we can obviously, with those people who wanted the consultation, we can deal with stuff one-on-one as well. But if you do have questions, feel free to ask now. Otherwise, you can start to drop off, and we'll see you next time. Any questions coming through? Don't think we've got any. Most people just happy to go.
I think there's a fair bit to absorb there.
Yeah, I think so.
Bill, so
the recording will be coming out either later on this evening or tomorrow. So you'll get that. And the email that we send out with the link to the recording will have links to the download the calculator and some of the other things we've referenced as well. Okay, I think that's it, Greg.
All right, Phil, well done. Thanks to anyone that's left back on the webinar there, but that's it from us. Thank you.
Thanks, team. We'll see you on the next one. Bye-bye.